Imagine someone offers you a stock market indicator with a 90% hit rate over 30 years. Would you follow it? Most investors would say absolutely. 30 years, 90%. That's an incredible track record. Here's what the indicator says. When an NFC team, or a team from the original NFL, wins the Super Bowl, the S&P 500 goes up that year. From 1967 to 1997, this predicted the market correctly 28 out of 31 years. 90% accuracy. Of course, this is complete nonsense. There is no mechanism, none whatsoever, by which a football game could cause the stock market to rise or fall. But here's the uncomfortable truth. You're probably laughing at the Super Bowl indicator right now. Yet many investors make the exact same logical error every day, confusing correlation with causation. They just do it with fancier data. As Nobel laureate Ronald Coase once said, "If you torture the data long enough, it will confess to anything." This is the final episode of our series, and it might be the most important one because this trap is the hardest to spot. To understand why fake patterns appear everywhere, we need to talk about the mathematics of coincidence. Here's a startling fact. If you take 100 completely unrelated variables and compare each one to stock market returns, roughly 5 of them will show a statistically significant correlation, purely by chance. That's how the math works at a 5% significance level. Test 1,000 variables, you'll get 50 fake signals. Test 10,000, 500 convincing-looking patterns, all completely meaningless. This is called the multiple comparisons problem. The more things you test, the more false positives you find. And in the age of big data, we're testing everything against everything. Real examples of statistically significant correlations that are pure nonsense. U.S. cheese consumption correlates with the number of people who died tangled in their bed sheets. Correlation coefficient 0.95. The number of Nicolas Cage movies released correlates with swimming pool drownings, 0.67. Bangladesh butter production once correlated with S&P 500 returns at 0.75. All statistically significant, all completely absurd. So why does correlation fail as evidence of causation? There are exactly 3 reasons. First, pure coincidence, spurious correlation. 2 things move together by random chance. The Super Bowl indicator, cheese and bedsheet deaths. With enough data, coincidences are guaranteed. Second, the hidden third variable, what statisticians call a confounding variable. Ice cream sales and crime rates both go up in summer. Not because ice cream causes crime, but because heat, the hidden third variable, drives both. Third, reverse causation. The direction of cause and effect is backwards. When gold prices rise, people say, gold is predicting a stock market crash. But often it's the reverse. Stocks are already falling, so investors buy gold as a safe haven. The gold price rise is an effect, not a cause. Every time you see a correlation in investing, one of these 3 explanations applies. Your job is to figure out which one before you put money on it. Let's look at 4 common examples where investors confuse correlation with causation. Case 1. My technical indicator hit 3 times in a row. It works. A trading indicator gives a buy signal and the stock goes up. 3 times in a row. Surely this proves the indicator works. Remember what we learned in episode 2 about sample sizes. 3 data points prove absolutely nothing. The t-statistic is meaningless with a sample of 3. Here's a simpler way to think about it. Flip a coin 3 times. The probability of getting heads all 3 times is 12.5%. 1 in 8. Not remotely unusual. Now consider that there are hundreds of technical indicators, RSI, MACD, Bollinger Bands, stochastic, and countless variations. If hundreds of traders each use a different indicator, some of them will see 3 consecutive hits purely by chance. Those traders then declare their indicator works. The correct question is not how many times did it hit, but out of all the signals it ever generated, what percentage were correct? And that percentage must be tested out of sample, on data the indicator has never seen before. Case 2. When gold goes up, stocks go down. This feels intuitively right. Gold is a safe haven. Stocks are risky. They should move in opposite directions. But the actual data tells a very different story. In the 1970s and 80s, gold and stocks both went up. Inflation was pushing both higher. From 2000 to 2011, the relationship flipped. Gold rose while stocks struggled, driven by financial crisis and quantitative easing. From 2013 to 2019, gold was flat while stocks soared, almost no correlation. And from 2020 to 2024, both gold and stocks rose together again, flooded by liquidity. The gold-stock relationship is positive, negative, or non-existent, depending on the decade. Anyone who says gold up means stocks down is stating a rule that changes every few years. The hidden third variable here is the macroeconomic regime: inflation, interest rates, liquidity. These forces move both gold and stocks, but in different directions depending on the era. Case 3. Low PE means undervalued, buy it. This is value investing 101. And there is a real long-term correlation between low PE ratios and higher future returns. But correlation is not causation, and treating it as a simple rule is dangerous. A low PE might mean the stock is cheap, or it might mean earnings are about to collapse, making the current PE misleadingly low. This is the classic value trap. Banks and energy companies structurally trade at low PE ratios, not because they're undervalued, but because the market assigns them permanently lower growth expectations. Buying every low PE stock without understanding the third variable, sector, growth trajectory, business cycle, is not value investing. It's pattern matching without thinking. Case 4. This strategy crushed the backtest. You design a trading strategy, test it on 10 years of historical data, and it shows 20% annual returns. Ship it? 3 traps are hiding in that backtest. Data mining. Test enough strategies, and some will look great by coincidence. Overfitting. Your strategy learned the noise in past data, not the signal, so it will fail on new data. And publication bias. Nobody publishes the 99 strategies that didn't work, only the one that did, creating a false impression that profitable strategies are common. So how do you tell real signals from noise? Here's a 4-step checklist you can use every time you encounter an investment thesis. Step 1. Check the mechanism. Ask, why would this work? There must be a plausible causal pathway from A to B, not just the data shows it. That's not enough. You need a logical reason. Super Bowl wins causing stock market moves? No mechanism. Higher corporate earnings leading to higher stock prices? Clear mechanism. If you can't explain why something should work, it probably doesn't. Step 2. Check the sample size. Remember episode 2, the tyranny of small samples. 3 hits means nothing. Even 30 annual observations is a small sample. A strategy that worked for 3 years has no statistical significance. A correlation measured over 30 years of annual data has only 30 data points, barely enough to draw any conclusion. And if the relationship only appeared in the last 5 years of those 30, you have even less evidence. Step 3. Test out of sample. This is the single most powerful filter against fake patterns. Split your data in half. Build your model on the first half. Test it on the second half. The Super Bowl indicator had a 90% hit rate from 1967 to 1997. After 1997, its accuracy collapsed. This is the hallmark of a spurious correlation. It doesn't survive out-of-sample testing. If a strategy only works on the data it was built on, it's curve fitting, not insight. Step 4. Check for third variables. Ask, is there something else driving both A and B? This is often the hardest step, because third variables are invisible until you look for them. Gold and stocks. Macro regime is the third variable. Low PE and returns, sector and growth are third variables. AI ETF outperformance. Monetary policy might be the third variable. Let me walk through a real example. AI ETFs have beaten the S&P 500 for 3 straight years. Should I buy AI ETFs? Step 1. Mechanism. AI companies are growing earnings faster. That's a valid causal pathway. Check. Step 2. Sample. 3 years. Statistically weak. Caution. Step 3. Out of sample. We can't test this yet. The trend is too recent. Caution. Step 4. Third variable. The Federal Reserve cut rates aggressively and liquidity surged. Growth stocks broadly outperformed. Was it AI specifically, or was it cheap money lifting all growth stocks? Unknown. Conclusion. The mechanism is sound, but 3 years of evidence during a favorable monetary cycle is insufficient. The AI story might be real, but you can't confirm it from this data alone. This is where our journey ends, and where your real work begins. Over 6 episodes, we've built a complete statistical toolkit for investors. Let me bring it all together. When you encounter any investment idea, run it through this 6-step checklist. Step 1. From episode 3, check the base rate. What is the historical success rate for this category of investment? Biotech going to blockbuster, 12%. High growth sustaining 5 years, 1%. Know the odds before you play. Step 2, from episode 4. Look for the graves. What similar investments failed? If you can only name the winners, you're seeing survivors, not reality. Step 3, from episode 2, check the sample size. Is this based on 3 months of data or 30 years? Is the t-statistic above 2? If not, you can't distinguish skill from luck. Step 4, from this episode, verify causation. Is this a real causal relationship or just a correlation? Can you explain the mechanism? Does it survive out of sample? Step 5, from episode 5, stress test for fat tails. Can your portfolio survive a 40% drawdown? Because in a fat-tailed world, those drawdowns happen, and they happen more often than any model predicts. Step 6, from episode 1, ensure diversification. Remember, only 4% of stocks create all the market's wealth. Is your portfolio structured to capture those winners? Or are you gambling on picking them individually? Run any investment idea through these 6 filters, and 7 or 8 out of 10 will be eliminated automatically. The 2 or 3 that survive, those are your real opportunities. Investing is a probability game, but most investors play it without knowing the probabilities. The 6 principles in this series aren't complicated. The hard part is applying them consistently. When you're excited, when you're scared, when you're sure you're right. As Buffett said, the stock market is a device for transferring money from the impatient to the patient. Understanding statistics is what gives you the patience. Thank you for watching the entire series. If these ideas changed how you think about investing, share them with someone who needs to hear them. And remember, the numbers don't lie, but they don't always tell the truth either. Your job is to know the difference.